Camera a little. Hello, everybody. Welcome to the first live training session with Eric for Profit Bandit Elite. I'm very excited that you're here today. So today we have one case study, Disney, the happiest place on earth. Now, a lot of people know Disney. You know, it has theme parks in Florida, in California, Tokyo, Paris, Shanghai, Hong Kong. Those are the newer ones. But a lot of people don't know they also own Pixar and Marvel. And this will become important later. So when I start my analysis and evaluating if a stock is good to buy, I always start with the chart. So here it is. Here's the chart. So just so you know, if you can't hear me, let me know. I'll try to check the chat from time to time. If you have any questions, you can type in the chat. So here we are. Here's the chart. So before we start, let me hide all the indicators. So then we start with a clean chart. Okay. So if you're wondering what this software is, it's tradingview.com. And let's start with the trend. So this is a weekly chart. That means every single candle on this chart is a week. So you can see that this is 2017, if you can see my mouse, and this is 2016, and this is 2015. So you can see that, you know, when Disney dipped into this zone between blue and red, which is a 200 EMA for blue and 100 EMA for red, it usually bounced back up. And if I move myself here, you'll see that generally Disney has a great trend, which is good. Okay, this is the first one you look for as a trend. Then we look at the Bollinger Band, which shows you volatility. So if you look at this, you'll notice that it's leaning towards the lower side of the volatility. So another signal that is top. If you look, bottom. If you look at the most recent low, you'll see that right here is the most recent low at around $92 to $91. Okay, and right now it's at $98. So it's pretty close to the low, and you'll see that it doesn't really dip below the blue line, so it might signal it's a good opportunity. So if you look at the latest news, I'm just scanning here to see if there's anything important. So Star Wars is coming, obviously, Stranger Things, Wonder Woman, that's not Disney, that's the competitor. Okay, so nothing really popping out here. And you can see that there was a few significant drops. So I did some of my research earlier, and I was tracking Disney for a while. So the main reason is A, the hurricane hit Florida pretty hard. So then that destroyed Disney's Florida theme park, and which is why people expect that their performance is going to go down, which makes logical sense. And the hurricane season is around 2-3 months ago. So you can see that, you know, there's a downtrend, which makes sense. And there's also a second reason, but I don't remember it off the top of my head. But either way, that's one of the two. So Disney, when you look at the company's future, what are we expecting? Well, Pixar is releasing its new movie, Coco. And there's a new movie for Star Wars, which is under Disney now. And there's another new movie, which is Thor, and it's coming out really soon, maybe in a week or two. And these three movies, I expect them to be great hit. So if they're going to be a great hit, now this is an assumption, so you got to pay attention, then the revenue of Disney is going to go up. And let's say in 2018, of course, Disney will fix its Florida theme park. And the chances of USA having another damaging hurricane to hit Disney again, it's really low. So A, 3 movies that are going to release: Thor, Coco, and Star Wars. And of course, there's another Star Wars movie next year. Second, the Florida theme park will be fixed. So right now, people are shorting it because they're not comfortable with the Florida theme park being destroyed and other problems and so on. And finally, the chances of a hurricane like this to happen again, it's really low. Okay. However, if you look at the monthly chart for Disney, you do notice that in the past, like back in 2009 and 2013, it's around $30, and now it's around $98. So it went up a lot, significantly, and it is, at a historical high. I don't think Disney has ever been this high. Exactly. So I'm just zooming out here, and Disney has never been this high. Okay, good. So back here. Okay, so we did the analysis on chart, and we also understands the company's performance. I actually have a kind of a plan here laid out. So I'm supposed to start with the disclaimer. The advice provided in this video is only general advice. The video does not guarantee or suggest the amounts of money you can make in the market. And as of October 28th, 2018, I do not hold any Disney stocks, bonds, and I'm completely independent from Disney. So if you have attended my free webinar, which is an hour, you'll know that I use the 7 sources of information to help me make an investment decision. Now, this uses the company strategy, which we have went through, basically the upcoming movies and so on, fixing of the Florida park. Second, the chart, which is what we just analyzed, the EMAs and the Bollinger Band. And now let's look at the company's performance and ratios. So for that, I use Morningstar. Now, just let me take a look to see if there's any chat. Nope. Okay. So here we go. Disney. So let's go to financials. So I only use Morningstar for the ratios, the financials, just easier for me. So 5-year trend, revenue going up. Great, fantastic. Second, net income going up. Now, this is the 2016 September net income. So given that the Florida was hit pretty badly by the hurricane, I would expect the net income for September to go down. But as of October 28th, of course, they wouldn't have released their latest financials. So let's go to quarterly. Again, net income is steady for the last 4 months, and so it's not really going up or down. So in the September quarterly report, I would expect the net income to go down because the hurricane, the destruction of the theme park in Florida, right? Okay, let's take a step back. So if you look at it, earnings per share is around $5, historical maximum. Okay, so it's $4 to $5 if you look at the last 3 years. So if you just do some quick math, over the next 10 years, if Disney makes $5 each year, it would be $50. So assuming Disney maintain the current amount of net income and not grow, okay, of course Disney is growing, we would expect Disney to be worth $50, which is right around here. Now, if you're in finance major, you're going to use discount rate, you're going to adjust for a bunch of stuff, but for simplicity, I'm just looking at how much money is Disney going to make for the next 10 years. And the next 20 years, it'll be around 100. Okay? So it's just to give you a range, a sense of how much Disney is worth compared to how much it is priced. So technically you can argue, well, Disney can grow and make even more money over the next 10 years, and Disney is a brand that will last for years to come. So that's why the baseline would be at least 50. So this is just to give you a ballpark figure on how to think about the financials. Really quickly, instead of going through all the adjustments. Okay, let's look at cash. Again, great increasing amounts of cash. Let's see if there's anything weird here. Inventory, normal, AR, normal, PB&E, normal. Okay. So if something looks normal to you, then it wouldn't give you additional information. So the next thing I would look at is debt. Now, they also have kind of an increase in debt, but then you see that they have a very healthy amount of shareholder equity. Now, at this point, you can probably calculate the debt to equity ratio, which is 1-to-1. And from my personal experience, that's pretty good. I have seen companies with literally no equity and 90% debt, and that's really bad. So you can see that Disney is not in distress at all. So if Disney needs money to fix its park, boom, right there, 4.2 million. I wouldn't have a doubt. Chances are they will take more debt management's decision to fix the park. But either way, I'm quite sure they're able to fix the park. All right. So we did the financials now. Let's look at the ratios. And the best thing about Morningstar is that they actually calculate the ratio to you and compare with the industry average. Now, I don't really look at the S&P and the Disney 5-year because I just want to compare Disney within its industry. So right now, price to earnings, Disney is lower than the industry average, but that's because it's not calculated based on the latest one because it's not out yet. The report is not out. So then I suppose it makes sense why the price to earning is lower than average, because once you lower the earnings, that ratio will shot back up. Price to book, similar to average, okay. Price to sales, a little bit above average. And then price to cash flow, a little bit below average. Now, usually when I'm looking at this, I'm seeing if there's anything weird or anything outside of the ordinary. So right now, it seems like they're pretty on par. If not, is slightly below the industry average. So even if they're below the industry average, though, if you look at the monthly chart, they're at an all-time high. So you just got to keep that in mind. Like, if Disney's price continue to go down, what you would do, and Disney's price continue to go up, what would you do? Okay, so right now, we did company strategy, chart, company's performance, ratios, news. Okay, market psychology. So looking at this chart, how does it make you feel? Chances are you'll think, whoa, it's going down. That's bad. Good. So that means a certain amount of people will be fearful. Well, if you think about it, after this jump, most people will start to get greedy. So then you want to buy when others are fearful. So, okay. That means from a chart, the psychology side of the chart, this also presents a good buy. So company strategy, just to recap, is a good buy because there are new movies that are going to be released. The Florida park will be fixed, and everyone knows about the hurricane and how badly it hit Disney. Fantastic. So it's reflected in the chart, which means it's reflected in the price. Second, chart at a support level close to the previous low, lower part of the Bollinger Band, between 100 and 200 EMA. There isn't really anything else I can ask for from the chart side. Fantastic. Finally, company's performance. Great cash, sufficient amount of money, not a lot of debt, only 1-to-1. Ratios, slightly behind an industry average, fantastic, underly valued, but that's because the new report is not released, so then the earnings is a bit higher than it should be. News, nothing really popped up. Market psychology, everyone's kind of scared, not sure what's happening next. So notice I didn't cover the last one yet. And as of this point, without looking at the last ones, Disney would be like a 95% buy. Now, I don't have any Disney stocks, and because I'm fully invested in other opportunities. So if I'm going to invest in Disney today, here's what I would do. Now, remember, I'm a stock option trader. I only trade stock options. Disney stock option. So I'll go through all the way and select what stock option I would buy for Disney. But before I do that, it's important to know that if Disney pays dividend. So in Morningstar, we know that Disney pays dividend. So you got to keep that in mind, because when you buy a stock option, let's say you buy for 2 years, it doesn't offer you the dividend. So you're actually missing out on the dividend part, which is 2% or whatever. But in the grand scheme of things, if you really want to buy a stock option, if you really think the price is going to go up, and if you really think Disney is great stock and you're convinced, then this shouldn't stop you. So what I just did was I Googled Disney stock options, went to NASDAQ, and here we are, $98 Disney, and here is what I called option chain. So like I always do, I only select call, which means it's mainly for people to go long. So put is for people that are expecting the price to go down mostly. And then I do all moneyness. So the reason why I only do call is because stock has a natural tendency to go up. So you don't want time to be against you. Because if I'm going to buy a stock or buy a put, then the price better be in a downtrend, which is down here. Okay, so all moneyness calls. Now, before we even look at the option chain, let's take a step back. The movies are going to be released in the next 3-4 months or so. Okay. But the Florida park, is it going to be fixed that quickly? And if it is going to be fixed quickly, are they going to experience the sale increase quickly again? And chances are no. And I think a lot of people go to Disney theme parks in the summer. So they actually have spring to fix it. Okay. So what this means is, if they want to restore to their normal operation, I would expect a year, right? Okay, a year. So in the world of option, there is an expiry date on your investment. Now I go through what option is in detail in my free webinar, but just stick with me here. So if I expect something to happen within a year, I want to double that amount of time so that I'm never constrained in time. So if I think something is going to happen in a year, I buy the option for 2 years. So in this case, the only option that's available for 2 years is January 2020. So I'm going to click that. It's going to take a minute to load. Okay, no chat. All right. Okay, so I'm zooming in here. So the first thing we want to pick is strike price. So for my rule is, when the stock hits my strike price, I essentially lose the entire investment. So the strike price is like a safety line. It's where I don't want the stock to hit. It's the price where I think the market has trouble going to without going through a lot of resistance or going through a lot of support first. So historically, if you look at the last 2.5 years of Disney, price has never been to 78. Okay, so we know that we have a baseline right here. All right, so I'm going to make this green because for me, green means support and resistance. Blue means my actual entry price. Okay, so if you look at a shorter term, like last 1.5 years, price has never reached 86 as well. Okay, so that means if you look a little bit further, you will notice that the 3 bottoms are generally around $90. Now, given that some time has passed, given that all the negative news we know of are reflected, the chances of Disney hitting $90 is quite low, and it's below our blue line. So blue is one of the major support lines, and you know that Disney has not crossed the blue line for like 4 or 5 years. So if Disney crossed the blue line, I would be very worried, and I would suspect that is a change in trend. Now, I don't expect Disney to cross the blue line, and which is super important. So technically, I can say, oh, well, I'm just going to buy the strike at 95. But I'm a conservative investor. I hold for the long term, so I would suggest 90. Okay? So this is how I determine where the strike price is going to be. If you're more conservative than me, then you might want to do 80. That means if this Disney price hits 80, you would essentially lose your investment. Now, okay, so we have a bit of confidence that Disney wouldn't hit 90, given all these factors in play, understanding the company's strategy and what's happening with it. So let's look at it. 90. Right now, the price for this option, so strike, you see, 90. The price of this option is 16.5. So what does that mean? When you buy an option, the value of the option is usually the price right now minus the strike price. So let me take out my calculator here. So if the price right now is 98, then I take 98 minus my strike, 90. That gives me $8. Okay, that's the inherent value of the option. But then because we have a 2-year time span, we're paying a premium to hold this option for 2 years. So the option itself, if you want to buy it on the market today, is around 16.5, so 17 to 15, depending on how the market fluctuates. So we're going to use 16, for example. So that means we're actually paying a premium of $8. Okay? So that means if, let's say 2 years from now, and we want to break even, what is the price? The answer is 90 plus $16, 106. So if we buy the option today, it's going to be $106 for us to break even. Okay, so given the historical uptrend, assuming the market is not crashing, so the trend is still up, the chances of Disney being above 106 after 2 years, it's quite high. It's quite good. And I'm liking the odds. It's quite good. So I would almost be ready to buy. So, but before I buy anything, I actually calculate to see how much money or what is the price that Disney has to be for me to double my money. So in the world of options, I can double my money, and I can show you how to do that right now. So the option is worth $16, right? So if I wanted to double my money, that means my option needs to be worth $32 without the premium. So $32 plus 90, that's $122. So $122. So if Disney hits $122 anytime within the next 2 years plus 2 months, then I can double my money on Disney. And that's how I achieve such an enormous return using stock options in the market. So if you are convinced that what I all said is going to happen, and you think Disney will reach 122 within 2 years, then you should be pretty happy that you will be able to double your money, or you can expect to double your money. Now, just want to reiterate my disclaimer here that this is general advice. I don't hold any Disney stocks, and I'm not promising that you'll make any money. So moving on, I'm going to consider the last piece of evidence. Now, before I even go there, right now, I would give Disney a score of 97, 95, 95. That's how confident I am in Disney and the strike price. And if you're asking for me, okay, Eric, is this week the week? And I would say pretty much it. Pretty much it. Now, the only thing that could happen is that it might do one more wave like this. So after a drop, Disney might do a second wave right here. So then even if you buy right now and the next wave is not necessarily the wave that would take you all the way up to 120. So it might take 2 waves or it might take 3 waves. So I think given we're buying a stock option for 2 years, Disney has more than enough time to do 3 waves to get to 122, assuming there isn't a crash. Now, if we take a step back, it seems like the market is so high that a crash is imminent, but then you can't ever truly predict a crash. So when you buy stuff like this, you got to keep that in mind, okay? You got to keep that in mind. Because right now we're at the peak of a major cycle, and it is 10 years after 2008. So let's look at the last piece of evidence, because I'm giving a Disney a score of 95. The last piece of evidence is insider activity. That means whether management, directors are buying and selling the stock. So first, you see that a bunch of people are buying. In just last month, 60,000, 78,000, 60,000, 78,000. Great. They actually buy 102. So again, if you see that the board members are buying at 102 here, it shows you some sign that it might be good because you're on the right side. Now, look at this. Robert, the CEO of Disney, sold at 104, $104, $104 and $105. And that is right here. Right here. Let me check the time for you. September 6th and August 8th. August. Okay, actually, I think I read the date wrong. It's June. Okay. June. Right here. Okay, makes sense. So let's think. The value of all the acquisitions recently is only like around 70,000 each. There's like 10, 20 of them. But the CEO sold 25 million plus another 34 million. That gives us 59 million, is around 60 million in Disney stock in June. Now, why would he do that? Why would he do that? So one possible reason is that, of course, Disney, it's at an all-time high. If you look at the monthly charts right here, 105, right? Good price to sell. It's at an all-time high. Second, he might not expect Disney stock to continue to go up, which is why it explains all this ranging activity, because he's basically offloading his stock. So I was going to buy Disney, but then this is actually an observation pointed out by my friend yesterday. And if we go to the holding summary, the person with the most shares held is Robert, the chairman of the board and CEO. And right now, the market value of his stock is $100 million. And in June, he sold 60. That is not a small number. That is a significant amount of shares that he sold. So there might be other reasons, I don't know, but you can see that a lot of directors are having a positive expectation of Disney because that's why they're acquiring a bunch of stocks. But the chairman and the board, the chairman of the board and the CEO, same person, sold 60 million in stock. And because that's such a strong negative indicator, I would drop my confidence score from 95 down to 80. And that's it. So now it's up to you to decide if this is a suitable investment for you and your portfolio. But from an analysis standpoint, that's all you need to know. All right. Aren't any questions today? So that's it. Have a nice day. The replay will be up tomorrow. It takes some time to process. So I'll let you know and I'll send you an email when the replay is back up.